Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Okay, welcome back to the Corton Aemelia Quant Fund podcast. We missed last month. I apologize. I was on vacation, so we thought we'd just wait for another month of crazy markets so to provide you with an update. Whoops. So I thought I'd just wait till this month to provide you with an update of these volatile times. Firstly, the disclosures. I'm Mark Deriet, founder of Amelia Capital Management Corp., an independent firm that develops quantitative models that have been licensed to and implemented by Corton Capital Inc. Corton is the investment fund manager and portfolio manager of the Corton Aemelia Quantitative Fund and its underlying fund, Corton Aemelia Quantitative Fund LP, each a related issuer of Corton. This is my mugshot, so you can skip over that quickly. So starting with the top-down indicators, there was green lights and red lights, and had we looked a month ago, there would have been a lot of red lights in the far right of this table. And we've seen a big improvement in a lot of these factors: beta flow vol, sector rotation, risk appetite, etc. The S&P was in a yellow light. It never got to a red light, importantly. We'll talk about that. And now it's turning back up out of the penalty box. So, volatility is being squeezed out of the market. It's possible that it reasserts itself, but we're just following these strict rules that we have, and we've got a lot more green lights in very quick fashion. The S&P, so it made a stand at this red line that we like to talk about in our work, and that is roughly 20 months. It's 80 weeks. The level here was 62.50 roughly that it bounced off of. And the momentum is close to turning back positive. We look for this weekly RSI to get back above 60. It's 59 and change. So a very quick, sharp downturn and a sharp V recovery, similar perhaps, but a lesser magnitude to the taper tariff trend. I'm sorry. And then when we look above this red staircase is a technical indicator we watch. It considers the volatility of a chart. So now we're out of the penalty box, breaking above there. If we close the week here above that, we do have to have a weekly close. So we're on alert for that, obviously. Anything can happen these days. If we're able to break above 7,000, we see upside towards about 74.50 based on this base pattern. And the support is 6,700. And then back down, the major support again is around that 62.50, 6,300 level. That is a very important line in the sand for the cyclical bull, and we'll show you why. So that same red line, 20 months roughly, is here, and the dashed green line is a 200-day. And you can see that you get whipped on that 200-day many times when you're in a bull trend, 90s, since the mid-90s to 2000. And then that red circle shows you finally break the red line. Similarly, from 03 to 08, about 4 or 5 times below the 200-day, and then you finally break the red line. And it's not perfect. You can get whipsaws like in 2015 and so on, but that line in the sand has held, importantly. So again, the S&P was in the penalty box. It never got into the red light zone. The global equally weighted index of around 3,000 stocks came back and actually held up better. It didn't get anywhere close to that red line, which is around 4,000 on this index. Got to around 42.50. It held the green line, which is the 200-day. And if we extend this horizontal support line back to the 2021 highs, you can see that it's held above that as well. That's kind of the bull market line of the sand from our favorite equally weighted index. We know that the world is kind of shifting to different leadership. And on the right here, we show the world ex-US versus the S&P on a long-term chart. And it's starting to reverse a 15-year downtrend. And you can see the monthly momentum has popped up above water here for the first time. And similarly, the TSX to the S&P is reversing a 15-year downtrend. We got last week, Wednesday, what's called a follow-through day. And this was developed by a famous investor in the US called William O'Neill. He passed away last year, unfortunately, but he had a stellar track record for many decades. He has this idea that you have any sort of magnitude up day in the market, and then that's the setup for a rally potential, and then you get a significant up day following that. Typically, 4 to 7 days is the window that he looks at. And that's what happened. Day 5, we got this big follow through day. And we simply overlay the blue lines of those prior follow through days. And on average, it happens 1.2 weeks or 6 trading days after, and you give up 5% off the bottom. You can see you can get whipsaws in the drawn out bear in 2022. The first follow through day was in May. And we don't show it on the chart here, but in 2000 and in 2008, there were many, many false signals. You got many follow through days. So it doesn't tend to work as well during prolonged bears, but you can see in these more V-type bottoms, it has worked fairly well. So breadth measures on the right, the short term has turned back up. So that's giving kind of a light green light, if you will, not a dark green. The longer term on the left is still correcting. Will take some time to turn back up, but importantly, it's still above zero, or sorry, above neutral 50. It's at 56%. So, showing a correction, not a lot of damage underneath the hood from a longer term perspective yet. And then we also show here in red, the red bars are for the Russell 3000, the percent of stocks that are making 52-week lows at any given time. And we didn't get this warning sign where this red bar goes more than 10% new lows. The last time we got that warning sign was in November of 21. And you can see I've circled in yellow the prior ones. Sometimes you get this huge downdraft like last spring, and you go right down to where we call blood in the streets when you're more than 30% new lows, and that's generally a good time to buy. But again, there wasn't as much damage underneath the hood to suggest a warning sign for a big bear market. Another way we look at that is for the same Russell 3000, the percent of stocks above the 200-day. Just if you're above that, you're in an uptrend. Below, you're in a downtrend, as simplistically defined. We look for a break below 40% as that warning signal. And once that happens, you tend to fall all the way to sub 15%. Now, we just had that washout, blood in the streets, in the spring of last year. And the black arrows show the gaps between, the duration between these signals. On average, you can see this table on the left, it's 40 months between signals, and the median is 35. The quickest was 15. So we're saying the bulls should have time on their side. You can get these 10% drawdowns. So on average, you get one a year, but not necessarily the base case that we would go all the way down and get really washed out again. So it's good that we've held that 40% line in the sand. That can reverse, not tomorrow, but the next month or two, and we could get a warning sign, but it hasn't happened yet. Shorter term breadth measures on the left is a very tactical indicator, the S&P percent above its 20-day. And we did get into the zone where you buy the dips. So on this indicator, we like to see it sub 20, and sometimes it goes even sub 10%. And then it reverses back up. So that did happen. And it was odd that it took over a year to get this kind of buy the dips moment. Normally this goes up and down like a yo-yo. You can see, and on average you get 4 of those dips per year. But again, we just got one. On the next slide, sort of things that may be on our radar is confirming the new uptrend. This is a concept by a man named Jeff DeGraff. He has a firm called Renmac in the US. He's the #1 technician there. We used to speak to him many years ago when he was at Lehman Brothers, for those who've been around back then. The red bar, sorry, the green bars show 4-week highs in the S&P. So at a low, you tend to get these breadth thrusts, they call them, when a lot of stocks move up aggressively off bottom. And he tested that you need to see that get above 54%, where I've shown these colorful vertical lines overlaid on the S&P to give the kind of all clear signal. That hasn't happened yet, so we haven't had that breadth thrust yet. We have, though, some other internal measures that we follow gotten a bit of an all clear. So this is for a basket of about 800 stocks in Canada. That's our focus, not the US. And the green bars show the number of 3-month highs at any given day versus the lows in red. And the blue line is simply a 10-day average of the spread between the green and the red. So the net new 3-month highs on a smooth basis. That has just flipped positive again. And we can see it turn negative. That blue bar went below zero on March 16th, to be precise. We did have a spike in new lows, and now that's reversing itself. The last 2 times you can see it reversed, the market did have a nice trend after that. So mid-April, for instance, after the tariff tantrum, it's quite a steady uptrend. So this can also change on a dime. You know, you could have bad news coming out geopolitically and so on that could cause those red bars to spike, but that's not the tendency. Here is a simple list of hunting ground. These are the stocks among that long list in Canada, about 800 names, that are closest to their 3-month highs. You can see there's a variety of sectors. They're all color-coded by sector. So this is a good hunting ground. The idea that, you know, before the market breaks out to a new high, you look for the stocks that are leading the way. And these are, you know, a smattering of those stocks that we've been increasing weight or adding to the models based on this concept. Volatility. So volatility spiked, and this is for currencies, bonds, and equities. And now it's really settled down quite quickly. So that's turning into a green light. You know, a quiet market, a non-volatile market is a sign of a healthy market, whereas a noisy market is very volatile. So hopefully the noise levels have dissipated here for good. And then credit spreads had a pretty brief spike up and are settling back down as well. You know, you can see they got quite a bit higher during the tariff tantrum last spring. This is about half the damage. Now we're back below these moving averages, so risk on there. The red line shows credit spreads, a basket of them, but inverted, and the blue line is the market. And the last 2 drawdowns, there was no warning sign from credit. You can see usually the credit market sniffs out problems ahead of equities, and perhaps it's because these are kind of exogenous Trump-driven events, if you will, who's got the hand on the wheel, which you know, we'll leave our commentary on that. But you know, you don't see any warning signs that you typically get from the credit market, so it makes for a more difficult environment. Commodities, the breadth in blue is quite strong. You can see 77% of the commodities in this basket are in a bull trend. Tends to track this red line, which is the US PMI, a leading indicator for the economy, which was stuck in the muck for about 3 years. That's coming out of its funk. And importantly, we're not back here where everyone is exuberant. You know, this PMI made a record high in the spring of 21, and that was the time to sell. So there's potential for further upside in the economic cycle. We rate commodities, we rank them by momentum. Not surprising, energy in red is at the top, but it's running quite hot. The far right columns here are a 26-week and a 2-year rate of change, but normalized. You can see the shorter term measures more than 3 deviations above the mean for oil. Precious metals are still stretched on a long-term basis. These were running, you know, silver was running at +5 deviations during our last podcast a couple of months ago. So it's got the stuffing knocked out of it and still arguably overbought, big picture. This is the raw industrials index. It doesn't have oil or gold or anything where financial players are involved. They're all listed, the indicators or the constituents on the bottom here, things like scrap steel and copper and rubber and so on. If there is a recession, if the oil price is going to take its toll on the economy, this line will turn down. And the good news is that it hasn't happened yet. Oil, this is a shorter term chart, zooming in because the action has become quite volatile and it's starting to turn down. You can see it broke the first line in the sand. It's the orange line, a 21-day. That's a very tactical, but about a week ago it broke that for the first time. So we're looking for this to come off the boil, towards the 84 areas is one, but 80 is a bigger support, just below 80, around $78. That should be good for the broader market. We like copper versus gold here in the red line. You can see the big gap versus the US PMI, again, a leading economic indicator. So that's kind of unprecedented. We're looking for copper to gold to turn up. It's starting, it's early days, but looking for that ratio to catch up. And the price of copper on the left really only emerged from this pretty big base pattern going back to 2021, a few months ago. It's reminiscent of gold a couple of years ago, and it broke out to all-time highs. We get a target of around $8 on copper from this base. The equivalent move for gold would have been around 3,300, and it got well north of 5,000. So we think that's a fairly realistic objective for copper. The big support is at $5. And the right shows copper stock ETF, global base metals is PICK, relative to the gold miners. So the stocks relative to each other. You can see it's in the zip code where it bottomed the last 3 times when the economic cycle turned. And we're starting to perk our heads up there. Not quite definitive yet, but I think that's a good risk reward. Rates. So this is the 10-year yield. And remember that COVID low where you hit just over 30 basis points on the 10-year yield. That will show you maps out with a big rotation we're seeing from a sector perspective. So the long-term trend of the 10-year is now up, not down. This RSI, this long-term, this is a quarterly chart. The momentum indicator gave its first buy signal above 60 here, this green circle, since the sell in 1985. That's a pretty long signal. And it's very impressive that yields have held up so well, correcting more in time than price. And we're looking for them to eventually resolve to the upside. Now, that could be an inflation story because of commodities, which could weigh on the market, obviously. Could potentially be a global growth story as well, which would be a better outcome, or maybe a mix of both. The Fed in red here, the Fed funds rate, and the 2-year yield in blue. The 2-year has popped its head up above that red line for the first time. So Fed rate cuts are off the table for now. The good news is that once you start a rate cutting cycle, there's been 8 since the mid-1980s, half of the 8 have resulted in a recession. These are the red bars. And while as the other half have resulted in soft landings. And the recessionary scenarios, you can see the rate structure collapses. The 2-year yield just falls off a cliff. And that is reflective of a lack of demand for capital as the economy is going into a big downturn. So the good news is perhaps we've pulled off a soft landing here with the 2-year yield starting to turn back up. This could, with lack of Fed cuts, weigh on the market, discount rate, and so on, and potentially more so to growth stocks. Recession or not, one of the timely macro indicators we look at is this blue line. This is called the Fed Weekly Economic Index, and it has mostly what they call hard data in it: gasoline sales, electricity usage, retail sales, etc. And it's very timely. Once a week you get it. And it hasn't fallen off a cliff yet, so oil has not yet taken a bite out of the US economy anyway. And you can see these surveys, how people feel versus what they're doing in the blue line. The surveys would have said there was a recession back in the mid 2020 period. Now the surveys are starting to improve. That PMI as well is in blue here, and the red line is a ratio of high beta stocks versus quality stocks. So they tend to trend together, and that ratio is still it's favoring high beta stocks, and not yet an extreme, right? So if that PMI were way up here, we'd think maybe beta has had its day. The labor market continues to cool and not collapse. You can see that yellow arrow, the slope of it is a lot less aggressive than those 4 red arrows when we've had recessionary times. And we're still well above the neutral 0 line. So the labor market just got so tight post-COVID that it's definitely cooling but not collapsing. So no recession there. Our chart of the baker's dozen of risk trades, which rolls in risk trades across broad financial markets, are all listed in the box on the left, has turned back up pretty aggressively. So that's another green light we're seeing from our indicators. And then sector rotation, cyclicals versus defense, has started to pop its head up back in favor of cyclicals. Our kind of heat map here for sectors. So the long-term score is how this table is sorted, which maps out with the x-axis on this chart, and the short term is the far right. And you can see the improvement. So materials ex gold have had a nice jump on the long-term rankings. Industrials and utilities as well. That's more of a power-related trade. And we'll go to the next slide. This is kind of the most important one to me. Remember that COVID low of the 10-year bond yield at around 32 basis points. That was also the low in this ratio, which is energy and financials relative to tech and healthcare in the denominator. So kind of short duration stocks versus long duration growth stocks. And indeed, that bottom when the 10-year yield bottomed, and ever since it's been grinding higher, it's broken that long-term kind of trend channel. And this is a quarterly chart. The red line, you can see that thin red line is a 20-quarter moving average. That's your tanker, if you will, the oil tanker, pun intended these days, that has turned up. So we think that's a big trade that's driving all these other trades like the rest of the world versus the US and TSX and so on. So we're looking for financials in particular here to start to catch a bit. And we're seeing it. Canadian banks, for instance, have been very, very resilient and making new highs. Some of the US banks like Citigroup is very strong and so on. So I don't think I added the chart here, but the ratio of the relative strength of global financials relative to the world has emerged from a 15-year trading range about a year and a half ago. And that's what happened to technology in 2016 after the tech wreck of 2000. So generally takes, a decade and a half to repair that damage. So for financials, it was the great financial crisis. So we think that's going to carry the ball from here on in. These are just some of the screens that we show, the sun rain chart for the top 100 stocks. So we're looking for the stocks that are emerging from the rain and in this improving camp with the idea that you rotate clockwise into the sun, and then you start to peel off when you get into the lower right weakening camp. These are some of our quant screens, big caps on the left and small to mid on the right. So these tick all of our quant and momentum boxes. This is where our models are leaning as always. And then the performance last month. So a bit of a frustrating month, to be honest. The blue line is the gross returns of the fund. The red line is the TSX, which at one point was down around 9% drawdown, and the fund at the time was down about 3.5%. And then the end of the month, the last day, the market had a big pop, I think 2.6%, and the fund was actually down a little bit because it was very, very defensively positioned. So that last day of the month certainly hurt us. So we ended down 4.3%. So this is the past performance. These are some of the winners last month and the losers. The fund has lagged the market now a little bit by 4% since inception. The beta, however, is 0.5. So we thought we did quite a decent job of managing risk, which is our modus operandi. That's the #1 criteria last month, but it just didn't end very well. With the market indicators turning back to green, we have been increasing the beta of the fund. Again, our #1 criteria is not to lose your money and to try to keep up with the market. So this month is starting off on a good footing that way. That's it for me. If you have an interest, please contact David Jarvis at Corton, and thanks for your support.